coming up on the SBS On the Money podcast. New RBA board appointments, mixed news on China's economy, and the US Federal Reserve prepares to meet to discuss interest rates. That is all next. Hi everyone, it is your daily 10-minute business and finance news wrap for this Monday, the 16th of December 2024. The Australian share market fell today by about 0.6%. We'll have the details with Mathan Somasundaram from Deep Data Analytics. But first, the Treasurer has made his appointments to the new boards of the RBA. Renee Fry-McKibben and Marnie Baker, the ex-Bendigo Bank CEO, will join the interest rate setting board with current board members, but Carol Schwartz and Ilana Rubin will shift from that board to the governance board, joining the likes of ex-Telstra CEO David Thodey and the BCA's Jennifer Westacott, just to name a few. So for his take on the boards, I spoke with Shane Oliver, the chief economist at AMP, and first asked him what he thought of the appointments to the Monetary Board.
Look, I think these are actually very good choices for several reasons. The two new board members are very well credentialed. One has 35 years experience as a banker, understands the macro finance scene in Australia. The other one is a very well credentialed macroeconomist with stints at other central banks and obviously was one of the review members. So I think they're excellent choices. Very hard to argue that they're political appointments, that they're stacking the board. It's also worth noting there's a high degree of continuity here. That was one of the big concerns, that we're in an important point in the interest rate cycle. We need to have continuity. We don't need a dramatically changed board. It could sort of upset the apple cart and delay necessary rate cuts, for example. But we've got 7 of the 9 board members transitioning to the new monetary policy board, which I think is also a good sign. And finally, the fact that we've got some pretty well-credentialed people coming into the board, that helps improve the macroeconomic understanding of the sort of issues that they have to grapple with around interest rates. And so I think that does go a long way, particularly when you add in people like Ian Harper, Ian Ross, who are still there, who have good understanding of the economy and price setting and wages and so on. Having them on the board, plus the representatives from the Reserve Bank and Treasury, I think we now have a pretty well-credentialed monetary policy setting board in Australia, which I think goes a long way to alleviate the concerns that the review had.
So what is there that makes you think that this won't necessarily change the way the board thinks when it comes to setting interest rates?
To be honest with you, I was a little bit concerned that we might have 4 or 5 new members appointed to the new interest rate setting board. That could change the dynamics. It could be characterised as a big change. As it is, we're talking about incremental change. So we've got 7 of the 9 board members transitioning to the new board. That implies a high degree of continuity. They've been there through most of the last cycle, which has largely been about raising interest rates, of course. And of course, that same board is now eking towards eventually cutting interest rates with the more dovish commentary we saw last week. So I think it's a pretty good move by the Treasurer to just appoint more people to the board and displace existing board members. I think could have led to a lot of uncertainty. In the words of economists, we would say, well, we don't know what their reaction function is going to be. We don't know how they're going to respond to economic data. Now, with 7 of the 9 transitioning, it's likely we have a pretty good idea as to how the Reserve Bank will respond. And I think at the end of the day, they're going to respond to economic data. So if we get good news on inflation in the months ahead, particularly in late January, if we see a bit of a bounce back in the unemployment rate, then by the time we get to the February meeting, and almost certainly by the time we get to May, I think the Reserve Bank Board will be in a position to start cutting interest rates.
The opposition, as one would expect, said earlier that they're not necessarily happy with the appointment, saying that the Treasurer didn't take the consultation process with the opposition seriously. We had clear names provided. We wanted all members of the current board transferred across to the monetary setting board. You mentioned how by not doing so, it's good in terms of continuing the way the RBA board thinks. Can you run us through again why you think these concerns about board stacking in favour of the government doesn't concern you right now?
Well, I guess the big worry was that this new board would be stacked by people who are more inclined to vote for a rate cut, potentially ahead of a May election, if the election is called that late in the cycle. And therefore, the current government could be accused of going soft on inflation, and that could result in bigger problems down the track. That seemed to be the main concern. As it's turned out, I don't think that's an issue because 7 of the 9 are transitioning to the new board. So we've got a lot of continuity there. The 2 people who are coming on, one is a banker. It's hard to believe that a banker is going to be soft on inflation. The other one is a very well credentialed macroeconomist who I don't have a strong view as to whether she's a hawk or a dove. I mean, I'm going to start from the premise that she's probably neutral and she's going to be looking at the data as it comes in. So that's just, to me, fairly neutral appointments here. They haven't gone down the path of branch stacking. If it was just a bunch of former unionists or something like that, then you'd be a lot more concerned. But we're not seeing that. We're seeing something which looks pretty balanced here. In fact, one of them is a business person. And, the coalition, you'd think would be reasonably happy with that. I think I do have some concerns, though, that it would have been nice to involve the coalition in this all the way along and getting their sign off and voting for the restructuring of the Reserve Bank. And, of course, in terms of the choice of new representatives, because that could then impart a degree of bipartisanship, because we now run the risk that perhaps next time around, if the coalition wins, then they might push it one way, but like the US Supreme Court, for example, they might push it one way. Labor comes back in, they might push it another way. So those risks are still there. But for the time being, they've been alleviated because only 2 new members are going on to the interest rate setting board.
While the Monetary Policy Board is gender diverse, there doesn't seem to be cultural diversity there. I mean, this is arguably one of the most important boards in the country. And at a time, the board previously said that it is looking to improve diversity within its own organisation too.
Yes, I would argue that this is, in fact, the most important board in the country in terms of its ability to affect so many Australians via interest rates. I think it gets a big tick in terms of gender diversity. 5 of the 9 members of the interest rate setting board are female, so that's a very good move. That's very progressive. But yes, we're still lacking in multicultural diversity. Not much there at all. Very, very white. And I think that reflects a problem the government faces, and that if you go to the higher echelons of business and macroeconomics, there's not a lot of people with a multicultural background. There is a few there, but the pool is a lot more limited. I suspect that as time goes by, just like we've seen more females rise through the ranks, we're going to see more people of multicultural background rise through the ranks as well. So if you go 10 to 20 years down the track, I think you'll have a lot more for the government to choose from in making the board more multiculturally diverse rather than just gender diverse. So I think we're heading in the right direction, but we've still got a fair way to go yet.
Final question. There are some big heavy hitters on the governance board, the likes of ex-Telstra CEO David Thodey, BCA boss Jennifer Westacott. What do you think the message that's trying to be sent here is?
Well, I think the key message here is that the government is trying to set up a governance board that is very, very strong. People with strong business credentials on that board. Obviously, it doesn't want any perceptions that it's going to be a slack board, that it's just the Labor's mates and all that sort of stuff. It looks to me like they're trying to try to set up a structure which, if anything, looks fairly bipartisan and has a leaning towards real credential business people focusing on what is very much a business-oriented board.
That's Shane Oliver there, the Chief Economist at AMP.
Now, Market Day on the SBS On the Money podcast.
Australian share market fell today. The S&P ASX 200 off by 0.6% to 8,249. A lot of that had to do with China and lower commodity prices. So for the details, I spoke with Mathan Somasundaram, Deep Data Analytics CEO. Mathan, the ASX is down today. Why?
It's mainly the uncertainty with China weighing on our currency, and because the dominant player at the moment is global investors, and irrespective of what they do, when the currency goes down, they're losing money. So as the currency goes down, they'll be selling out of the big sectors, which is predominantly banks and miners, and they're the ones weighing on the market.
Yeah, what do you make of China's economy? Some stats came out today saying retail sales down, industrial production up. It comes about a week after the government announced some potential policy measures as well to stimulate the economy. What's your take?
Yeah, look, they've been talking about the very similar context for nearly 2 years. They are willing to act when things get really dicey, but they're not trying to stimulate it too much. I mean, they spent 3 to 4 years deflating their property bubble because that was hurting their demographic problem. So I don't think they're in a rush to ramp that back up as much as the market would love it to. So it is more about the consumer-driven, tech-driven outlook. So that's a gradual process. It's not going to be big. And for China, it makes no sense to suddenly do a lot when you're a month away from potentially trade war with US. So that's going to have an effect. That'll hit the economy. So they're trying to do gradual things and see how these things play out. It's hard for them to see how these or what level of tariffs that'll come through. And obviously they're going to react. They've even said that if trade war plays out as they expect, they may have to let the currency devalue. Now that's a big risk for Australia because if the Chinese currency devalues, generally Australian dollar devalues with it.
The US Federal Reserve meets this week. What's expected and what are the market implications?
Yeah, this is a real tricky one because the data doesn't back what they have been talking about. They've been talking about potentially job market weakness, which hasn't come across. It's actually been very strong. And they've already done substantial cuts, but the bond market has actually pushed up the bond yield. So despite the US Fed doing a number of cuts, the bond yields are actually higher than where they were before the cuts. So the bond market does not believe the US Fed. So I expect the Fed to do the cuts today. This week. That's almost a given. The probability is, I think, almost 100%. So they're going to cut. The important thing is what they say about it, because at the moment, the currency market and the bond market are calling their bluff. And the markets are winning and the Fed is losing. So they need to win back the trust. And so what they say is going to be critical.
We spoke about the changes to the RBA board with Shane Oliver from AMP just a few moments ago. From a market's perspective, does the market care about these changes?
This is another fascinating moment in time because RBA does not get reformed that quickly, and this is a big move. Now, the government ideally would love to have a number of rate cuts before the next election cycle, which was in play. But the numbers are too strong. So it's almost impossible to see RBA cut now. And then you look at what's happening with the currency. So in reality, RBA is telling you we're looking at trimmed mean inflation. Now, if you look at trimmed mean inflation and the interest rate, Australia actually has very low real interest rate when you compare it to countries who've already had numerous cuts. So it's very hard for RBA to cut in a weak currency outlook. So we already have a weak currency. If they cut, it'll get even weaker and that'll add to the inflation. So it's hard to see them cut, but the market obviously is looking at this and saying the government wants to make the changes to try and boost the probability of a rate cut. Now, everyone will wait and see how this plays out. If they cut, then it'll be fascinating to see how the logistics of this is going to play out and how they're going to explain it. So at the moment, the market doesn't see this as a big change, but the market will wait to see what they actually do before judging it.
Okay. Any company news catching your attention today?
I don't think there's much happening in the company news. We had management changes, Ingham, in the code ING, and that wasn't a huge change. I think that's, from an internal change perspective, I don't think that makes a huge difference. I think the big thematic at the moment for me is what's happening with ASIC in terms of NTR services and Downer EDI. Those things have had a dramatic pullback in the stock prices. The uncertainty of the regulatory side of things, we've seen this now play out. When initially we had it in the banks and we went to the supermarkets. Now we're stretching out into the services sector. So I think there is going to be more and more of this that's going to come out as the election cycle plays out. So expect more uncertainty in sectors where, they earn too much for too long.
And finally, where do you see the opportunities for investors at the moment?
I think you stick to the basics. What we're seeing now is inflation is starting to rise around the world, in most countries, apart from China, and that's going to play out into the underlying thematic for sectors. So we still like the gold sector as the hedge against risk and inflation. Generally, when you have inflation, energy sector tends to rebound, and energy's been the underperformer, so we like the energy sector. And of course, we love the food sector, and the outperformers in the food sectors, after a long period of time where marketing companies do well, now it's the actual producers of the food. So, boring milk producers, boring rice producers, agricultural land manufacturers, people who manage the land, they're all doing really well. So the food sector looks pretty interesting.
That is Mathan Somasundaram there from Deep Data Analytics. This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.